Welcome to Trading an Edge, where we break down the psychology, mindset, and system of elite trading. Today, we're doing a deep dive into something really insidious. It's the silent threat, maybe the biggest one, to your long-term success: unmanaged emotion. Our sources are pretty much unanimous on this, and our mission today is clear. We're going to prove to you that, look, before you can even think about successfully managing capital, you absolutely must master your mind. We'll explore exactly how those unchecked feelings, systematically destroy your consistency.
And let's just start with a disruptive truth here, something that kind of flips the usual script. Most traders, they really believe the critical job is managing risk. That's what they focus on. But the reality, trading success is ultimately about managing emotion. It really is. Until you master your internal reactions, your psychological responses, well, your account balance is always going to reflect your state of mind. Always. Not the quality of your strategy.
That's a huge distinction, isn't it?
Yeah.
Managing emotion versus just managing risk. I mean, for decades, amateurs were told, just remove emotion, just switch it off. But our research suggests that approach is, well, fundamentally flawed. You can't just remove it. And actually, trying to do that completely misses the point of what these feelings are trying to tell you. We shouldn't aim to eliminate them, right? We need to understand what they are.
Exactly. We have to stop seeing emotions as some kind of character flaw, like you failed somehow. We need to view them as biological facts. Simple as that. From a clinical performance standpoint, emotions aren't the enemy at all. They're critical biological signals, and they point directly to incomplete awareness, or maybe a gap between your expectation and what's actually happening. They're just feedback. That's all. Pure feedback.
Okay, let's unpack that feedback loop then, specifically around, say, a trading outcome. How does that work?
Right. It's all defined by perception, how you see it. We
Right.
generate these signals based on how we perceive an outcome against our own, subjective expectations. So when you perceive more pleasure than pain, let's say you nail a perfect profit target, you feel good, positive, maybe even infatuation or pride. And that's the psychological route that quickly, very quickly morphs into greed.
That euphoria, that feeling of, I was right.
Precisely. And then there's the opposite cycle. When you perceive more pain than pleasure, think about an unexpected drawdown or hitting a deep stop loss. You feel bad, negative, maybe resentment or even shame. This is what fuels fear. Psychologically, that's where it comes from. Now, the critical point here, and this really separates the elite from the amateur, is that both these states, the high of pride and the low of fear, both immediately distort your judgment. They push you right off your established logical edge. Professional traders know this. They don't suppress emotion. They study it. They learn from it.
And if you fail to study it,
Yeah.
if you're trading while letting these signals just rage unregulated inside you, you are, for all intents and purposes, blind. It's like trying to steer a car through a busy city street, but your windshield is completely fogged up. You're still moving, right? You're placing trades, moving capital around.
Yeah.
But you're completely blind to the facts of the trade setup, blind to what your proven process actually tells you to do. Clarity, that objective presence you need for consistent execution, it only comes back when that fog of emotion clears.
And that clarity is just essential because it lets you actually see the environment you're operating in, see it for what it is.
Right.
We have to move past this psychological illusion of outcomes. We need to understand the fundamental nature of the market itself.
Which is
neutrality.
Just neutral.
Utter neutrality. This is the deep psychology bit.
Okay.
Look, the market is just an engine of exchange. That's all it does. For every winner in a transaction, there has to be a loser, and vice versa. It's a zero-sum game at that level. From the market's point of view, the outcome of any single transaction is completely neutral. It balances out. Losing a trade isn't some cosmic judgment on your character or your intelligence. It's just a price movement. That's it. Winning and losing are subjective experiences. They're shaped entirely by our internal expectations and, our past experiences.
Okay, but if the market is neutral, why do we take losing trades so personally? Why does it feel so bad? Where does that shame or resentment actually come from?
Because we are the ones doing the labeling, we mentally tag those neutral price movements. We transform them into good or bad events in our heads. A loss, for instance, it's simply something that goes against our subjective idea of what should happen. It reflects a critical mismatch between objective reality, what the price actually did, and our deeply held belief about where the price should go. The pain isn't really the dollar amount lost. The pain is that internal conflict of being proven wrong.
And the flip side, the win. It feels great, validates your analysis, but that carries its own psychological danger, doesn't it?
Oh, it's incredibly seductive, highly seductive. When reality aligns with your idea, it feels fantastic. But that very feeling can dangerously block learning. It can reinforce confirmation bias like nothing else. You start feeling kind of invincible. And that leads you to ignore risks, maybe rush your checks, assume the next setup will play out exactly like the last one did. So both reactions, positive and negative, are really obstacles to objective decision making.
So the core psychological insight here is absolutely paramount then. True consistency, the kind that leads to profit. It only begins when you stop assigning emotional value, good or bad, to the outcomes. They're just data points, nothing more.
Exactly right. But let's get into the practical, the really destructive consequences of failing to detach like that. We know that both losses and wins are necessary, right? You need them to develop a robust strategy. Losses offer lessons, wins offer validation. Both are needed.
Yeah, but it's the emotions they generate that fundamentally disrupt your consistency. That's what kills profitability over time. Let's start with the positive cycle, maybe the more subtle one. What happens when a trader gets that rush, that winning feeling, the pride?
That positive energy, well, it's lethal if it's not managed, seriously. Winning or those positive emotions, they lead straight to pride. And pride is really just greed wearing a subtle mask. This state causes overconfidence. It leads the trader to rush into poor quality setups or maybe increase position size recklessly, way beyond their plan, or place orders outside their plan windows. These emotional highs, they just cloud judgment. They distract the trader completely from their established process, their edge, and ultimately it leads to breaking rules because they feel like their intuition is suddenly better than their tested rules.
And the negative cycle is often much faster, much more brutal. A swift account killer sometimes. When losing triggers fear, and that often turns into resentment, almost like you're angry at the market. What kind of behaviors does that resentment cause?
Oh, it causes haste and total irrationality. We've all seen the charts or maybe even experienced it ourselves where a trader tries to chase back a manageable loss only to turn that small loss into a massive drawdown in like 15 minutes.
Wow.
This impulsive need to quickly recover losses, that's classic revenge trading. Fear completely overrides the process. It just takes over. It's that moment the trader just abandons their plan because the pain of the loss, that internal conflict of being wrong again, is just too much to bear. So whether it's positive or negative emotion, the state itself acts as this powerful distraction, pulls you away from your long-term repeatable edge.
Okay, so if we accept we can't just switch off these biological signals,
Yeah.
and we accept that both positive and negative states distract us from being consistent, what's the operational solution? How do we actually channel that powerful biological signal constructively? How do we use it?
Right. We need a system, a rigid, systematic approach. You can't wing this. The solution is basically a 5-step framework. Traders have to actively train themselves, really train, to use the emotion itself as immediate feedback. It's about transforming that raw feeling into actionable data.
Okay, let's break down that training process then, because it is a process. You have to start somewhere. What's step one?
Step 1, acknowledge the emotions. Simple, but not easy. Do not suppress them. Don't fight them. Recognition has to be instantaneous. You need to see that feeling, frustration, anxiety, maybe even euphoria, as immediate feedback, not as a moral failure, not as I'm a bad trader. Just identify it. Name it immediately. Okay, I'm feeling fear right now.
Right, acknowledge it. Then step two is decode the signal. But okay, for a trader feeling really frustrated, what does decoding actually look like, practically speaking?
Decoding means digging into what the emotion is trying to reveal about your current expectations or maybe awareness gaps. For instance, if you feel intense fear right after you place a trade, that signal probably means one of two things. Either you put on a position size that's just too large for your account, psychologically or financially, or you didn't fully plan the trade. There's an awareness gap. Something's missing in your prep. If you feel excessive pride after a win, the signal is telling you you're probably attaching your self-worth to the P&L. And that makes you vulnerable to overconfidence, maybe skipping risk checks on the next setup.
Ah, okay, so the emotion isn't really about the trade itself in that moment. It's about a flaw in my preparation before the trade.
Precisely. Which leads directly into step 3. Expand awareness. You must shift your focus immediately. Get it away from the emotion itself, that subjective feeling, and back onto the objective facts. Back to the facts of the trade setup, the chart, your execution plan. Being present like that restores balance. When you consciously move your focus from, oh man, I feel anxious, to, okay, the price is currently at resistance and my stop is set here, you regain control. You can stick to your trading plan regardless of the internal noise.
Step 4 feels really crucial for preventing this emotional roller coaster in the future. Reframe expectations. How does someone practically lower their attachment to the outcome of this specific trade?
Yeah, this is the preventative medicine, so to speak. Look, the emotions you feel after trade are shaped almost entirely by what you expected before the trade. It's cause and effect. If you go in fully expecting to win, then any loss feels devastating. High expectations amplify reactions. So you have to actively work on lowering your attachment to individual financial outcomes, trade by trade. The only expectation you should carry into any trade is the expectation of perfect execution. Executing your established process flawlessly. That's it. Focus on just entering trades without those outcome-based P&L expectations tied to them. This psychological shift, it drastically lessens the emotional weight and helps keep your reactions much steadier.
And finally, step 5, the payoff. Use emotion as data. Convert that raw energy, good or bad, into insight that actually sharpens your discipline. Let's tackle the negative side first. How does something like resentment, which we know causes terrible revenge trading, actually become useful data?
Okay, the drawback of negative emotion is obvious, right? Impulsive, irrational revenge trading that blows up accounts. But the benefit, the data aspect, is that resentment highlights the exact point where reality crashed into your expectation, where they didn't match. That emotion provides the data point. It forces you, if you let it, to reflect and ask, okay, what specifically in my plan failed here? Or what expectation did I unfairly project onto this neutral market? It points out structural weaknesses, maybe in your entry criteria, your risk setting, maybe even your psychological prep before you even sat down. It prompts necessary reflection and, importantly, adaptation of your process.
And on the flip side, the positive emotions. We all want confidence, but as you said, not overconfidence. How do we turn that rush from a win into usable data instead of just a license to gamble on the next trade?
Right. Positive emotions like confidence and pride, they are beneficial for reinforcing good behavior. That's the upside. But the drawback, as we said, is they lead directly to overconfidence and risky impulsive trades if unchecked. So to use it as data, you have to actively log why it was a success. Focus on the rule-following behavior that led to the win, rather than just celebrating the P&L outcome itself. You use that positive energy to reinforce your discipline. If the win came because you waited patiently for a high-quality setup and you stuck strictly to your risk limits, then the emotions should be channeled into reinforcing those exact rules. Make a note of it. Ensure you stick to the process that generated the win instead of using the financial success as an excuse to immediately break those rules next time.
This has been a really powerful deep dive. I think we've clearly established that emotional awareness isn't some soft skill, an optional add-on. It is the absolute foundation of successful, consistent capital management. It really is. If you can't manage your mind, you simply cannot manage your money effectively over the long run.
Let this be the final thought, the provocation maybe, that you carry forward from this. If you cannot manage your emotions, you will never manage your capital successfully, not consistently. Because the market doesn't actually test your strategy nearly as much as people think. What it really tests is your self-control.
Trading an edge, where psychology meets profitability.